Good evening, everyone. This is Komal Tyagi from Team Taxman, welcoming you all to today's live session on Decoding GST for Real Estate Sector Part 1. I would like to start with a brief about Taxman. We are the leading publisher of tax and corporate laws in India. We maintain the largest and the most accurate online database on income tax, international taxation, GST, company and SEBI law, IBC, FEMA banking and NBFC, competition law, accounts and audit, and Indian acts and rules. Over the years, we have worked strenuously to offer the solutions that will continue to help you grow your practice. Our 6 decades of experience in the domain has helped us to constantly innovate and enhance our services and take the tax practice to a newer height. We have also developed the national website of the Income Tax Department and we maintain it with the help of our technical team and the editorial. Now I welcome our speaker for the evening, Mr. Tushar Aggarwal. Mr. Aggarwal holds an experience of more than 10 years in indirect tax. He has worked for more than 8 years with Lakshmi Kumaran and Sridharan attorneys. He has also deployed with GSTN for GST implementation and has worked closely with the government officials. He specializes in advising clients on complex indirect tax issues, structuring business operations, in identifying and advising on tax efficient business models, etc. He has been involved deeply in various sectors, including real estate, hospitality, aviation, and infrastructure, etc. This is our pleasure to have you with us, sir. Now, before we proceed, here are some tips for the participants. Your mic will be on mute. However, you may post your questions in the chat box available on your right-hand side. Your questions will be answered by the speaker during this session or after the session by the R&D team. A copy of the presentation on the subject matter shall be sent to you in email for your future references. Now, without taking much time, I must request Mr. Aggarwal to address the audience. Over to you, sir. Thank you.
Thank you, Komal, for your warm introduction. Good evening, friends. I hope you all had a nice festive holy season. Friends, in today's webinar, we will be decoding GST for real estate sector. So it will not be a theoretical discussion. We will be discussing the practical transaction and case studies being faced by the developers. Apart from that, we will also discuss the litigation issues being raised by the department. In fact, in last couple of years, departments like DGGI, anti-evasion, departmental audit, etc. have become very active and they are raising various kinds of issues. So we will be discussing these entire issues in our webinar and the possible solution to those issues. Since the number of issues and case studies are more, we have divided this into 2 parts. So in today's session, we will be discussing some of the case studies, and in second session, we will discuss the remaining case studies, including joint development agreements, etc. Before we drill down into the case studies, let us spend 2 minutes to have a look at the journey of indirect tax law for real estate sector. When I talk about real estate sector, I'm referring to a developer, a person who is constructing a building and selling the units, whether residential or commercial, to the end customer. I'm not talking about a contractor, etc. I'm talking about a developer developing the building on a land, maybe owned by him or owned by somebody else, and then selling it to the end customer. Friends, it was only with effect from 1st July 2010 that service tax was introduced on the developers. A deeming fiction was introduced during that period of time, stating that whenever these developers are constructing a flat and they receive any amount before obtainment of completion certificate, then that on that particular unit, they will be liable to charge service tax. At that time, no credit was given to the real estate developer. Similar provision continued effective 1st July 2012 when negative list of services was introduced. At that time, developers were covered under the concept of declared services. That is, there was a deeming fiction, deeming the services provided by the developer to the end customer as a deemed services on which service tax was payable, and they also introduced the concept of credit on input services availed by the developer. So in negative list of services, developer were entitled to avail credit of the service tax which they were paying on the input services. Please note, no credit was allowed on excise or excise duty paid on the purchase of material, etc. Before GST, we discussed service tax was applicable on the developers. Simultaneously, VAT was also applicable on the developers. Supreme Court, in the case of Larsen and Toubro, larger bench, held that whenever a developer is selling a flat, which is an immovable property, to the end customer, and they receive consideration before obtainment of flat, then there are actually three activities which are involved. One is the sale of immovable property. Second is the service element. Third is the supply of goods element. On the service element, we had service tax, and on this goods element, they upheld the levy of VAT on supply of goods embedded during the construction stage. So VAT and service tax both was applicable before GST was implemented. Now, when GST got implemented with effect from 1st July 2017, the situation continued. What they did is that they introduced a deeming fiction, specifically stating that supply construction of these flats for the end customer will be deemed to be a service. They specifically included this activity as a service on which GST was applicable at the effective rate of 12% at that particular point of time, and they introduced the entire input credit chain for real estate sector. The developer were entitled to avail input tax credit of whatever procurement they were making. And now with effect from 1st for 2019, again a sea change for the real estate developer. The rate of tax, which was effectively 12% before 1st for 2019, after 1st for 2019, this rate reduced from 12% to 5% for residential unit with no input tax credit. For commercial, it's still effective rate is 12% with input tax credit, but for residential unit, it is 5% without input tax credit. So why I'm referring to these periods? It is essential because we have to understand that this real estate project, it continues for a longer period of time, say 4 years, 5 years, 6 years. It may so happen that you have entered into a joint development agreement in 2016. Landowner gave the development rights to the developer in 2016. In lieu of that, developer is giving area to the landowner, and that area is being allocated in 2019. So provision of 2016 was different from 2019. So we have to keep in mind different period, different laws, and accordingly apply to the transaction in hand. So very, very important in real estate sector. Moving on to our case studies, etc. Let's first discuss two relevant provisions which are applicable for the real estate payer. We discussed that there is a deeming fiction which is introduced for the real estate payer. What is that? It is contained under Schedule 2, Para 5B. It says, very important, construction of a complex, building, civil structure, or a part thereof, including a complex or building, intended for sale to a buyer, wholly or partly, except where the entire consideration has been received after issuance of completion certificate, where required by the competent authority, or after its first occupation, whichever is earlier, treated as supply of services. In simple terms, this construction by the developer is deemed to be a service. If they are selling a flat, if they receive any amount before obtainment of completion certificate or before first occupation, then on that particular unit, they have to charge GST. Let me take an example. The unit value is 1 crore rupees. I book it for 10 lakh rupees before obtainment of completion certificate for that particular project. Then on the entire 1 crore rupees, GST will be applicable at the effective rate. Second important clause which we must note is Schedule 3. It deems certain activities not to be treated as a supply of goods nor as supply of services. Para 5, it says sale of land and sale of building other than what is covered under Schedule 2. Both this element is outside the ambit of GST. So no tax on sale of land, no tax on sale of building. Please note the word used are sale of land or sale of building. I will again be repeating these phrases, etc. in my case studies. So let us all remember the words which are used. Please note in Service Tax, what was excluded was transfer of title in immovable property. So in Service Tax, the exclusion was for transfer of title in immovable property. Immovable property is a very, very wide term. It may include movable immovable property, intangible immovable property like development rights, etc. These can be immovable property. But what is in Schedule 3 in GST regime? It is only sale of land and sale of building which is excluded. Now let us move to our first case study. Sale of flat by the developer to the end customer. A building is constructed, can be constructed either on a freehold land or on a leasehold land. When I talk about a freehold land, no issues. it's a freehold land, I'm constructing a building, selling it to the customer, I'm covered under this entry, and accordingly I will pay GST at the rate of 5% for residential units or 12% for commercial units. I'm talking about the present rates. What if my land is a leasehold land? Let me talk about Noida or many such regions where there is no concept of freehold land. Authority gave me a lease for 99 years. So I am a developer. I am holding a leasehold land. Lease is allotted to me for 99 years. I am developing a project on that leasehold land and then selling this project to the end customer. So there can be two ways of executing this transaction. Ultimately, you won't be able to sell the land to the end customer. Developer cannot sell because it is a leasehold rights. It is a leasehold land. So in any case, he has to give this land to the customer on lease only. It's kind of a sublease. But what about the superstructure? There are two ways of executing a builder-buyer agreement with the customer. First is you say superstructure is also leased. So effectively, whenever you enter into an agreement with the customer, you say I am subleasing you for 99 years. So land is also leased. Superstructure is also leased for 99 years. Then it's a transaction of lease of immovable property. It is not a transaction which is covered under para 5b of schedule 2. Friends, please note, para 5b of schedule 2 specifically covers only those buildings which are intended for sale. In this example, if you sublease the superstructure, then it's the entire transaction is of lease of particular unit only. If it is a commercial unit, entire 18% applicable. If it is a residential unit, exempted. Accordingly, we have to keep in mind the terms which are used in the agreement which you are entering into the customer. Second way of entering into this agreement is that you sell the superstructure to the customer. So the way you write your BBA is that I am selling this particular unit to you. The rights in the superstructure will be transferred, conveyed. The ownership in the proportionate superstructure will be conveyed along with sublease of land. So in this case, you are doing two activity. First is selling and conveying the ownership of the superstructure to the buyer. Second is subleasing the land. From customer perspective, the essential characteristic of this transaction is actually to purchase the units, wherein leasing of land is incidental to transfer of ownership of the superstructure. In India, it's a settled law that in a case of a leasehold land, land can be owned by somebody else and the superstructure on the land can be owned by somebody else. So using that proposition, which is already settled in India under the Transfer of Property Act, etc., we always have to keep in mind that all developers, if we are the developer or we are advising to the developers, we always have to refer to their BBA and see that in the BBA it is written that the superstructure is sold to the buyer along with sublease of land. Then only we will get covered under this particular entry of para 5b. Otherwise, if both land is leased and superstructure is leased, then it's a complete transaction of sale, leasing of property only. And in one of my client recent litigation case which I am handling, department has made this allegation stating that you have built a commercial project, land is on 99-year lease, superstructure as per the agreement is leased only, so it's a sublease of 99-year, entire 18% GST applicable, and they are also disallowing credit on the rentals because again we have that dispute of safari retreats etc. pending whether credit is eligible on renting of immovable property or not. So small wordings in the BBA can make a big impact. Moving on to our second case study. The law says I need not charge GST if I am booking the unit after obtainment of completion certificate or first occupation. So what do you mean by first occupation? Can I say that I am a developer, I am building a residential project, say 1,000 units. I built the structure and I completed few of the units and I gave possession to one of the parties, one of my customer. Since out of 1,000 units, one customer I gave the possession, so accordingly I'm covered under the concept of first occupation, and any booking I do thereafter, I'm not liable to charge GST. Can I take that proposition? Is it valid? Before we drill down into the answer, let's understand the meaning of first occupation. It is not defined under the GST law, so let's look at the dictionary meaning. When we see the dictionary meaning, what is you mean by first occupation? It says the action of living in or using a building or other place. The act or process of taking possession of a place or area. So it simply says when somebody moves into and start using a building, that is called first occupation. That is called occupation. There is an CBIC circular 354/32/2019 dated 7th May 2019. Therein, they have again explained the concept of first occupation. They said, what do you mean by first occupation? What is there in the GST law? Again, it's a circular, not a notification, not a law, only a circular, only a clarification, understanding of the government. It says first occupation of the project should be in accordance with law, rules and regulation of state government or any other authority. So whenever you say that I have given the first occupation, then that first occupation should be as per the local laws, property laws of that particular state, which is applicable there. It's not that you just make somebody live in a particular unit and say, I have given the first occupation. It should be as per the law. And as per the law, you can give occupation only if you obtain an occupancy certificate. Before that, you can't give an occupation. So that's the understanding of the government by this circular. So in my view, first occupation has to be read along with the local laws of the property, local property laws applicable to the developer in that particular state. Let me give you an example. Say in the state of UP, what happens when you apply for an occupation certificate or a completion certificate and you don't get it within 3 months, then they deem it that the completion certificate has been issued. Let me read the exact provision for you. Proviso to Section 15A of the Uttar Pradesh Urban Planning and Development Act 1973 provides that if completion certificate is not granted and refusal to grant it is not intimated within 3 months after the receipt of notice of completion, it shall be deemed that the completion certificate has been granted by the authority. So in these cases wherein you are not getting any completion certificate, etc., and there is a deeming fiction under the law, pursuant to which you have actually given the occupation to the customer, then the clause of first occupation can be invoked, and this deeming fiction along with first occupation together can constitute first occupation. So we have to read this first occupation along with the local Urban Planning and Development Act of the respective state and not in isolation. This is one of the most important issue being faced by the developers in Uttar Pradesh, etc. I've seen many people not getting occupation certificate, completion certificate on time. They start giving possession, etc. But in these cases, if the building is completed, you obtain an architect certificate, and there is a deemed completion along with first occupation, etc., then you can go ahead and say that I will not charge GST if the booking is done after the occupation. But this the occupation has to be along with this deeming fictions also and not independent. Now, friends, moving on to our next issue is on the rate of tax. After 1st for 2019, in respect of new projects, the rate of tax depends upon the kind of project I am executing. There are two kinds of project. One is residential real estate project. Second is real estate project. Residential real estate project means a project in which carpet area of the commercial apartment is less than or equal to 15%. Whereas a real estate project is a project in which carpet area is more than 15%. So in respect of RREP, that is residential real estate project, if I am selling a residential unit, my rate of tax is 5% and commercial unit rate of tax is also 5%. So this is the effective rate of tax. Actually, rate of tax is 7.5% and 1/3 is the land abatement, land deduction. So effective rate of tax comes out to be 5% with no input tax credit. Whereas in case of a real estate project, that is RAP, wherein the commercial project is area is more than 15%, in that particular case, for the residential units, you have to charge 5% with no input tax credit. And for the commercial units in an REP, that is a real estate project in which area is more than, the commercial area is more than 15%, you have to charge GST effectively at the rate of 12% with input tax credit available to the developer. So I repeat, in case of a real estate residential project, RREP, both residential and commercial units chargeable at effective rate of 5% with no input tax credit. And in case of an REP, that is residential, that is a real estate project wherein commercial area is more than 15%, residential units chargeable at 5% with no ITC, and commercial units chargeable at 12% with full ITC. In respect of affordable units, what do you mean by affordable unit? Affordable unit means a unit wherein the gross amount charged is less than 45 lakh rupees and which has a carpet area of up to 90 square meter in non-metropolitan cities and up to 60 square meter in metropolitan cities. In that situation, the rate of tax is 1%. So friends, it may so happen, say I am building a particular project in which less than 15% area is of commercial units. So 10% is the commercial area. Rest 90% is my residential area. And out of 90%, 20% are affordable units and 70% are non-affordable units. So for non-affordable unit, you have to charge 5% rate of tax. For affordable unit, you have to charge 1% rate of tax, effective 1%. And for the commercial part, 5%. So the biggest change with effect from 1st April 2019 is that rate of tax has to be determined unit wise. So for an affordable unit, you have to charge 1% only. It does not matter that in a particular project, you have only 10 unit as affordable unit. No matter, still the rate of tax will be 1%. So that's a very important point which everybody must note, specifically for EWS. In many projects, you also have to build EWS, and we have generally seen that all EWS units are less than 45 lakhs and the area is also less than 60 square meter in metro cities. So the rate of tax will be 1% with no input tax credit. And again, this condition of 1% come with certain conditions. This rate of tax of 1% or 5% for a residential project. First is you have to pay this 1% or 5% only in cash. You cannot utilize input tax credit. Second, 80% of the procurement should be made from a registered supplier. Please note 80% of the procurement must be made from the registered supplier. If it is less than 80%, then on the remaining amount, differential amount, you have to pay under reverse charge at the rate of 18% and no credit available. However, there is an exception. For cement, even if you purchase a single penny of cement from an unregistered supplier, still you will have to pay under reverse charge. So very important condition of 80% procurement from the registered supplier. And very important point to note, the law says 80% has to be procured from the registered supplier. And one of the biggest expenditure of the builders is the interest which they pay to the bank. So whether this interest amount which they pay to the bank, can I say that this interest, say 5 crore rupees of interest I am paying to a bank, this 5 crore rupees is the amount which I am purchasing from a registered supplier? Can I say so? Legally, the answer is yes. Very important to note. Legally, the answer is yes. Why? Because whenever bank is charging interest, then it is an exempt service as per the exemption notification under the GST law. So that is an exempt service, but banks are generally registered. So what the law says is that 80% procurement, whether of exempt supply or whether it is taxable supply, but it has to be from a registered supplier. So even interest is included in this. So RCM stands for reverse charge mechanism, wherein you as a developer have to pay. So this is a very important condition. If you are opting for in your particular project, if the rate of tax is 1% for affordable units or 5% for residential units, which are non-affordable, you will not be in a position to take any input tax credit. Whatever you are collecting from the customer, pay GST at the rate of 5% or 1%, and you have to pay under cash. And also you have to note that all your procurement, at least 80% of your procurement should be from the registered supplier. If it is less than that, you will have to pay under reverse charge mechanism, differential amount at the rate of 18%. Moving on to the next case study. So what we discuss is that input tax credit is not allowed for a residential project because your rate of tax is 5% or 1%. So you have to do planning. What planning? You have to save input tax credit, the GST which you are paying on the procurement, because no input tax credit is available. And let me give you a few ideas and examples. How do we have to do that? How to structure it? Let me take first example. I am building a completely affordable project. Rate of tax is 1%. I am building an affordable project. So in case of an affordable project, the rate of tax on works contractors, the contractors whom I will be appointing, the rate of tax is 12%. So rate of tax on a works contract In case of a affordable project is 12%. Now there can be two ways of executing a affordable project. First is I take interior designing services separately. I take architect services separately. I take works contractor services separately. So what will happen is that I am a developer. Architect will bill me GST at the rate of 18%, loss to me. Interior designer will bill to me 18%, loss to me. Works contractor will bill to me at the rate of 12%, again loss to me. This is one way of executing. Second way of executing is, let me introduce an SPV in between, a special purpose vehicle. I give the entire turnkey contract, end to end turnkey contract to that particular SPV of mine, say of 100 crore rupees, to construct my entire project. This particular SPV then hires the services of an architect who will charge 18%, interior designer, works contract, etc. So in this example, what will happen is that architect will bill me 18%, interior designer will bill me 18%, works contractor will bill me 18%, interior designer will bill me 18%, works contractor will bill me 18%, interior designer will bill me 18%. Sorry for the inconvenience. So we were on cost optimization part. So in case of cost optimization, what we were discussing was that the residential developer is not in a project in a position to avail the input tax credit. So we always have to ensure specifically that the way we are procuring goods and services, we attain best tax efficiency. And how do we do that? Let me take an example. We have seen in many cases developer themselves used to purchase cement and give it on FOC basis to the contractor. Now if a developer purchase cement, it will cost him 28%, no input tax credit available. Whereas if the cement is in the scope of the contractor, then contractor can claim 28% credit and then he will charge me only 18% GST. The planning which we can do is that we can identify the vendor from where the cement has to be purchased and tell the vendor to supply to the contractor only. So instead of purchasing themselves, route this transaction through a contractor model. So these are the small areas wherein we have to work together to attain maximum tax efficiency. Moving on to the taxability of various kinds of charges collected by the developer. Again, a very important issue being raised by various departmental officials at ground level. Basic selling price, no issues. It is either 5%, 1% or 12%. 12% for commercial, 5 or 1 for residential. What about preferential location charges? The issue is whether GST is leviable at the same rate as applicable on basic selling price or it is 18%. If we see what you mean by professional location charges, professional location is nothing but corner plot, sea facing plot, garden facing plot. So it is an inherent characteristic of the plot or the unit which you are purchasing, and it is not a separate services which a developer is giving to you. To my mind, PLC is nothing that professional location charges. Whatever you give to you, it is nothing but a part of basic sale price only, and accordingly GST at the same rate will be applicable which was applicable on basic sale price. But at ground level, friends, department is creating dispute, and this is because of various kinds of advanced rulings which is coming into picture. Say in this particular ruling, the AAAR held professional location charges are a separate service which has no association with land, and hence abatement cannot be available. Accordingly, entire 18% has to be applied. However, there are positive judgments also. In my view, it's a very, very good case to argue that the rate of tax on PLC will be same as it is applicable on basic sale price. To overcome the disputes at the ground level, many people have started box pricing. So instead of giving separate prices as BSP is 1,000 rupees, PLC is 100 rupees, what they are saying is that for this particular plot, BSP is 1,100 rupees. For this particular plot, BSP is 900 rupees. So they have started box pricing. Many developers in Delhi and NCR have started this concept of box pricing to overcome this problem. Otherwise, legally, PLC should be same as applicable on BSP. Moving on to the second set of charges. Car parking charges. Car parking charges, there are two kinds. First is the mandatory car parking charges, which you have to give along with booking of the flat. In that situation, what we have seen is that this particular amount also forms part of your stamp duty valuation for the purpose of stamp duty purposes. So the mandatory car parking charges which you pay along with BSP, the same rate should apply which is applicable on BSP, that is effectively 5% or 12%. However, if you are having any additional car parking, which is an option given to you for which you are paying separately, then it will be leviable at the rate of tax of 18%. So car parking, original car parking, mandatory parking, same as applicable on BSP. However, if it is an optional car parking, then 18% GST applicable. Interest on delayed payment. We have a specific valuation rule by virtue of which interest on delayed payment, like the customer gives me the BSP late, the customer gives me the preferential charges late. In that situation, the interest which I recover over and above the BSP and other charges, GST is leviable at the same rate as it applies to the original charges. Specific valuation rule is there. Another very, very important area which developers are facing, and many show cause notices have been issued in the state of Haryana for this particular issue, is of EDC and IDC. Whether GST is applicable on EDC or IDC or not. Friends, EDC and IDC is nothing but basic infrastructure work which is generally includes electricity, water supply, roads, etc., which is generally undertaken by the government. So what the local law says that please collect this amount from the customer and give it to the authorities. The issue is whether this amount, when I collect from the customer, am I liable to charge GST? If we see section 15, subsection 2, clause A. Clause A of subsection 2 of section 15 of the SACT Act provides that the value of supply shall include any taxes, duties, cesses, fees and charges levied under any law for the time being in force, and it will be included in for the purpose of valuation. So what department is saying that EDC, IDC, whatever I am recovering, it is nothing but charges levied under any law, and as per section 15 subsection 2 it has to be included for the purpose of valuation. And there is an advance ruling which is against us also. In the case of Ashana Housing, it is an advance ruling which is also against. So department at ground level issuing show cause notice and demanding GST on the EDC and IDC recovered. Friends, in service tax regime there was a circular which stated that EDC and IDC, whatever I am recovering. Am I audible?
Yes, sir, you are audible.
So EDC or IDC, whatever I am recovering, no tax has to be paid to the extent the same is given to the authorities. So if I recover 100 rupees, I give it 90 to the authorities, then on 10 rupees only service tax will be applicable and not on the 90 rupees. However, there is no such circular in GST regime. Over and above, you have a specific section, valuation section, which says that all taxes, charges has to be included for the purpose of valuation. To my mind, taking a call, understand that no GST has to be applicable on EDC, IDC because I am acting as a pure agent. Whatever I recover, I give it back to the government, is very, very disputable. DGGI, anti-evasion, no authorities will allow you to take this kind of stand. You have to actually fight till higher level to get any relief. And practically, GST is an indirect tax law. So today, if you charge from the customer, you can recover from the customer. Today, if you take a call not to charge from the customer, what will happen? Customer will not give to you. But ultimately, you will have to fight in the court. And tomorrow down the line, if there is a negative judgment, then it will have to be paid out of your pocket only. So as an advisor, I am advising all my clients that even if they have taken a call of not charging EDC, IDC during the initial phase of GST implementation, relying upon old service tax circular, etc., no issues. Now for the new projects, please start charging GST on EDC, IDC and avoid any dispute. The way valuation section is drafted, it will be definitely prone to dispute, to argue that no GST is payable on EDC and IDC. The next major issue faced by the developer is on sale of plot, and I will also tell you the current change in the practice which developers are opting apart from the representation which CREDI National is giving to the GST Council. When I sell a developed plot, what do you mean by sale of a developed plot? There is a bare shell of land, developer develops it. How it develops? There is no construction on the plot, on the area which I'm selling. It is the common amenity which is developed by the developer. It includes compound walls, entry gate, irrigation system, drainage system, water system, gardens, etc. These are the common area wherein right to use is given to the purchaser of the land, etc. A person who is purchasing the developed plot. Whether GST is applicable on sale of developed plot, technically speaking, we can all say what I'm selling is only a plot with a right to use common amenities. So sale of land, what was excluded under Schedule 3, what we discussed initially was sale of land. Since sale of land is outside the ambit of GST under Schedule 3, accordingly sale of plot, no GST applicable, as it is a sale of land with merely a right of use of common amenities, etc. When I come to the judgments, two sets of judgments are there in GST regime. One set of judgment, it says GST applicable on sale of developed plot because it is a service which is given to the customer. Let me read the extract. Sale of developed plot is not equivalent to sale of land, but is a different transaction. Sale of such plotted development tantamount to rendering of services. So we have this kind of negative judgment which says it amounts to a service. Second, we have positive judgment also, which says there is no service element, no GST applicable. Let me read the exact phrase for you. In the instant case, the entry 5B of Schedule 2 cannot be applied as these roads, poles, or drainages are not for sale to probable buyers of plot. Neither their ownership nor their exclusive possession shall be passed on the probably buyers of plot. Rather, these are intended to be eventually vested with the local authority. The principal transaction is the sale of land, and these amenities are a natural part of sale of plot of land, and hence no GST should be applicable. So we have both set of judgments. Somebody says GST applicable, some judgment says GST not applicable. My personal view, GST should not be applicable. Very good case to argue at High Court, Supreme Court that GST is not applicable, as it is only a sale of land. Amenities which is being built, only a right of use is given, it is not transferred. There is no works contract which I am doing to the customer. Good case to argue, but practically see what happens. I have seen in more than 10 developers, DGI visiting, anti-evasion visiting, department visiting, creating pressure and asking them to deposit the tax. Or they issue a show cause notice. Again, it will be a huge demand on the developer. They will have to keep fighting, etc. So the trend which I am noticing in last couple of months is that developer is trying to adopt a risk-free approach. And what is the risk-free approach they are adopting? They are bifurcating the amount of development charges in the BBA itself. So if I'm selling a land, say for 1 crore rupees, what they are writing is that my BSP is of 95 lakh rupees and other charges 5 lakh rupees. On these other charges, it is for the development cost which I'm incurring. So on the other charges, they are charging GST at the rate of entire 18%. So when I'm selling a flat, so instead of sale of flat and charging 1 crore rupees as BSP, I'm charging 95 lakh rupees as BSP and 5 lakh rupees as development charges. And how do I calculate this 5 lakh rupees? It is generally based on the cost which they are incurring on the entire project, the development cost, and they divide it into the total saleable area, based on which they arrive at the development cost, which they can show separately in the agreement. So in the agreement, they write specifically that 5 lakh is for the development cost and I pay 18% on the entire 5 lakh rupees, and accordingly also avail the input tax credit of the development which I have undertaken. So that input tax credit is also available. So to my mind, that is a much better approach. And whenever a departmental official comes, you can always justify stating that the activity of service which is involved in this transaction is maximum to the extent of development. Obviously, there cannot not be a service element on the sale of land as such. At best, it is only the development activity which I have undertaken, and I have charged separately for that, and I have paid entire 18% on that. And accordingly, since I'm paying 18% on my output, I'm availing input tax credit also, and commercially also it's a viable situation for the developer. So that is the advice which we generally give to all our clients. Please start following this approach to avoid any dispute at ground level. Otherwise, technically, we can always win at higher level that sale of plot is not liable to tax. Moving on to the next issue is of 99 year of lease. Is 99 year of lease equivalent to sale? The answer is no. Sale as per the Transfer of Property Act specifically involve conveyance of ownership of the property to somebody else, wherein the right of ownership is also transferred. Whereas when I give a lease of 99 year, at best I only give a leasehold rights. I don't transfer the ownership right. A land, a property consists of various bundle of rights, including right to enjoy, right to hold, right to own, etc. So whenever I'm giving something on lease, I don't transfer the ownership rights. So whether it is 99 year lease or whether it is 999 year lease, lease is a lease and it is not sale of land. We have various judgments under the service tax law, as well as various advanced rulings under the GST law, as well as this recent Bombay High Court judgment of Builder Association, wherein they specifically held that 99 year lease is a lease only. You cannot make it akin to sale of land, and accordingly tax will be applicable. Friends, in GST, there are certain exemptions which are granted on lease of industrial plots by the state authorities or government authorities. But that exemption is applicable only if the lease is by the state authorities or a local authority. Whereas if one private party lease say a commercial land for 99 years to another private party, then it is not a sale of land and no exemption is available, because both are private parties and accordingly 18% will be applicable. So that is the practical challenges being faced by the customers and the taxpayers, that as a layman they always understand 99 year lease is always akin to sale. but it is not the reality. Lease is a lease, sale is a sale. And in fact, CREDAI and various other associations has also represented before the government to introduce suitable exemption for such kind of transaction also. Next practical issue being faced by the developers is of cancellation of units. So a developer sells unit to a customer. He keeps on raising demand notes over a period of time. Let me take an example. He sold the unit in December 2017. Then in 17-18, he raised demand note 18-19, 19-20, 20-21, 21-22. He's still raising demand note. It's an under construction project. He's paying GST. Now, today, I go to the developer and I say, please cancel this unit. So in case of cancellation of unit, as per provision, he can raise a credit note as per section 34. He can specifically issue a GST credit note and claim the adjustment of the credit note issued by him. In fact, there is a circular also, FAQ also, which says that developer shall be able to issue a credit note to the buyer as per the provision of section 35 in case of cancellation of booking. Good enough. But I can issue a credit note within a certain period of time limit, which is prescribed under the law. That is up to financial September month of the next financial year. Now, in this particular situation, for period 17-18, 18-19, 19-20, and 20-21, for the demand notes which I have raised during this period, I will not be in a position to issue a GST credit note today in March 2022 because the time limit has already lapsed as per the section 34 of the CGST Act. Hence, no credit note can be issued and adjustment can be claimed only for the demand notes which I have raised in financial year 21-22. That is from April 2021 till March 2022. Whatever demand notes I have raised, I can claim issue GST credit notes only in respect of those demand notes and claim adjustment. Then what about the GST paid on the demand note raised from 17-18 till 2021? Is it a loss? Because I have collected from the customer and paid to the government. It is not going out from my pocket. It is going out from the pocket of the customer. And customer always demands this GST back. What do? Can I go for the refund? Refund, again, the provisions of refund is applicable only for 2 years. You can apply 2 years from the date of payment of tax. So at best, even if I want to go for a refund route, I can go only till last 2 years. That is from financial year 2020-21, not before that. And again, for refund, you have to first return the money to the customer and then only you have to go for the refund. Otherwise, the principle of unjust enrichment will apply. Very important to note, the principle of unjust enrichment will apply otherwise. So what do? It is a practical issue being faced by the developers. CREDAI has also represented it. And what developers are doing is that they are writing in the BBA itself that if a unit is cancelled, we will not be in a position to return you the GST amount to the extent I am not in a position to issue a GST credit note. So this is the way they are writing in the agreement and telling customers that will not be in a position to return the GST amount once it is paid to the government. Practically, if you want to legally argue, etc., then there are few judgments which have come out recently in service tax also, Pramukh Reality, and in GST also, this Haresh Kagnara. Here they have said that the period of refund has to be counted from the date of cancellation of unit. That is, this period of 1 year in service tax or 2 years in GST has to be calculated from the date of cancellation instead of date of payment of service tax or GST. Because the cause of action is undertaken only when the unit is cancelled and then only you realize that you have to take refund. So you can rely upon these judgments, argue before the authorities. At ground level, you will not get the refund. You have to fight. Before fighting, you have to return money to the customer. Then file a refund application. They will reject. File an appeal stating that time limit is not lapsed because refund time limit has to be calculated from cancellation of date and not date of payment. So it is a litigation issue. CREDAI and many associations have represented it that the provision of section 34 should be amended to specifically allow developers to claim benefit because their transaction is unique. Their transaction is undertaken for 4 to 5 years. It is not akin to a sale by a trader or a manufacturer, and hence they need a separate law. Let us wait and see what relief is given to the government by the government for this transaction. Another important issue incidental to this particular transaction is of the cancellation charges or the forfeiture amount. So whenever I cancel, sometime I retain cancellation charges. Say I raised a demand note of 1000 rupees. I paid GST of 5% or 12% on this 1000 rupees. However, at the time of cancellation, I returned only 800 rupees and I retained 200 rupees as cancellation charges. Legally speaking, we can always argue that on 200 rupees, I had already paid GST initially at the rate of 5% or 12% when demand note was raised. Now again, I need to pay differential 18% GST? Do I need to pay GST at the rate of 18% under the category of tolerate an act or not? Department at ground level is disputing and demanding GST at the rate of 18%. They are saying that when you are forfeiting this amount and when you are collecting cancellation charges separately, this 200 rupees which you are retaining, it is not for your construction service, but it is for an agreeing to the obligation to do an act or to tolerate an act. They are covering these charges against the entry number 5E, which read as under: agreeing to the obligation to refrain from an act or to tolerate an act or a situation or to do an act will be treated as a separate service. They are specifically covering this transaction under this act. In my view, it should not be covered under this particular clause because I am not tolerating this act. Rather, I have not tolerated and hence I have imposed a penalty. This is in the nature of penalty which I am charging. In service tax, we have a series of judgments on the similar issue of tolerate an act wherein they have said that liquidated damages, penalties, etc. is not leviable to service tax because it is a compensation which I am receiving. It is not a consideration against some activity of tolerating somebody's act. We have Southern Eastern Coalfield, we have Repco Home Finance, series of all positive judgment in service tax regime by the Honorable CSTAT, not even a single negative judgment. Whereas under GST, we have both set of advance rulings. We have positive advance rulings also, we have negative advance ruling also. So GST, the judiciary is mixed, whereas in service tax, we have positive rulings also only. So to my mind, it's a very, very good case to argue that no separate tax is payable since on the cancellation charges, you have already paid GST at the time of demand note. That is sufficient. No separate tax is payable. One of the most important issue which I would like to highlight and which is being checked by the investigation authorities at ground level is the reconciliation part. See, generally in real estate sector, your accounts are always different. Your revenue is booked either on percentage deduction method or completion method. So accounting is totally separate, whereas you pay GST basis the demand notes which you are raising or advances which you are collecting, whichever is earlier. So it may so happen that in GST returns, say you launched a project in January 2022. In first 3 months, you raised 100 crore rupees of demand note. In GST, the returns, the value will be 100 crores. In financials, the value will be 0 because percentage completion method not triggered, completion method not triggered. So accounting is always separate and your GST returns data is always separate. How do we satisfy whether my whatever liability is due, I'm properly discharging? And what we have seen in recent past is that GST department is reconciling the CRM data with the GST returns data. So always ensure that whatever demand notes you are raising in the CRM, it always matches with your GST returns, and also your tax liability ledger, which is there in your accounting, always matches with your tax liability, which is there in your returns. So matching of CRM data with GST returns data is of utmost importance. So that's the most important thing which you have to keep in mind. Second, if say I'm raising a demand note of 1 lakh rupees, an effective rate of tax is of 5% for residential units. In the GST returns, taxable value is not 1 lakh, taxable value is 2/3, that is 66,000 something. And your GST rate is 7.5%. This is the way you have to depict in your returns. When I say 5% or 12%, these are only effective rate. Otherwise, for commercial project, the rate of tax is 18% and 1/3 is the land deduction. So always 1 lakh is the demand note, 66,000 is the taxable value, and 1/3 is the land deduction. Don't show this 1 lakh in this 1/3 land deduction under your exempted turnover. This is not your exempted turnover. And CRM is nothing but your customer relationship management tool. That is my billing software. So whenever you talk about service industries like real estate industries, airline industries, telecommunication industries, in this day, the accounting tool is different. Accounting may be Tally, SAP, Oracle, etc. And generally, the billing tool, the tool from where the demand notes are raised, is different. So the billing tool, the amount which is there in the billing tool should always match with your GST returns. Most important thing which you have to keep in mind. Coming to the last issue for the day, and rest of the issues will be taken up in part 2, because there are so many other issues which are left, including joint development agreements, etc. So we will be taking the last issue for the day. Reversal of credit in respect of unsold units. Friends, what we discussed initially is that GST is applicable only in respect of units which you book before obtainment of completion certificate or first occupation. So any unit which is booked after obtainment of completion certificate, no GST is applicable on that particular unit. So let's take an example. You started a project in 2015. You started the construction part and the booking part, and it got completed in March 2022. It took 7 years to complete the project. At the time of completion, your sold area is 70% and your unsold area is 30%. I repeat, your sold area as carpet area, again, the area has to be carpet area. It is 70% and unsold area is 30%. How do I reverse my input tax credit which I have availed in GST regime, as well as the credit which I have availed in service tax regime? Because I took input credit in service tax regime also in 2015, in 2016, up to June 2017. What does the law says? Coming to the GST, the input tax credit which is I have availed in GST regime, Rule 42 and 43, we have a specific provision for real estate sector. Generally, Rule 42 and 43 is applicable when I provide taxable service as well as exempted service, and that is applicable based on turnover. Whereas for real estate, they have said that the reversal which you have to undertake is based on the carpet area of the project in the ratio of sold unit to unsold unit. So in this example, in this particular situation, whatever credit I have availed from 1st January 2017 till March 2022, I have to reverse based on the unsold area. 30% is the unsold area. So whatever credit I have availed in 5 years, I will reverse to the extent of unsold area. And it so happened that even if you have obtained completion certificate in March 2022, many a times vendor bills still keep on coming, because today it is completed, you verify the bills, they keep on issuing the bills in April, May, June, July 2022. Does it mean that any invoice which is coming after March 2022, no credit available? The answer is no. You are eligible to avail proportionate credit for that particular amount also. So whatever invoices which you receive after completion of OC, there also you can avail proportionate credit to the extent of sold unit, because those expenditure belong to sold unit only, on which you have paid GST. Department at ground level is denying. They are saying that any credit which you avail after obtainment of OC, it is not eligible. But that is a wrong understanding. Proportionate credit can be availed. What about the service tax credit? Am I required to reverse the service tax credit now in 2022? DGGI Lucknow issued notices to more than 20 developers on the very similar issue, stating that whatever credit they have availed in service tax regime, they have to reverse to the extent of unsold unit. In this respect, there are 4 to 5 favorable judgments which are to the relief of the developer, stating that in service tax regime, there was no similar provision the way which is there in GST regime, that you have to reverse based on area unsold. There was no such provision in service tax regime. So in service tax regime, at the time of receipt of services in 2012, 13, 14, 15, whenever you were receiving, your intent was to sell it. Your intent was always to use these services to construct the unit, and the unit was constructed for the purpose of selling only. Accordingly, the court held that since at the time of receipt of services, your intent was to sell the units, hence credit would be eligible. The fact that after 5, 6, 7 years, you obtain OC, and at the time of OC, there is an unsold unit, you need not reverse the credit because the law is not drafted in that particular manner. We have Alembic judgment of Gujarat High Court also. In the case of Alembic, favorable judgment, it is pending before Supreme Court. Then we have other C-state judgments also. So to my mind, no need of reversal of service tax credit in respect of project for which OC is obtained now. A very, very good case to argue. With this, we end up today's sessions. The rest of the case studies will be discussed in second part of our GST webinar. And now I will be taking up various question and answers raised by the participants. One of the issue raised is if we develop office fit out, for example, and we give on full space on rental, whether we are eligible to take the input tax credit or not. See, whenever I'm constructing a building for the purpose of rental, this will be one of the specific case study which we will discuss in the next session also. But I will just give a brief that whenever I'm constructing something for rental purposes, then you can divide your entire construction cost into 4 parts. One is the construction cost per se. Second is your movable items like various kinds of furniture, fixture, etc. And third is your plant and machinery like HVAC system, like lifts, etc. So you will be in a position to take the input tax credit of your plant and machinery and movable item like lift, fire extinguisher, HVAC system, furniture, projector, etc. But ensure you have a separate PO for all this. You will not be in a position to take the credit of the construction part, the civil part. So in rental cases, civil part credit will not be eligible, whereas the plant machinery part and movable furniture part will be eligible. However, for the civil part, since we have a favorable judgment in the case of Odisha High Court that they allowed the input tax credit and it is pending before Supreme Court, and you never know what judgment will give, Supreme Court will render. So what we are advising is that for the civil part, you take the credit and reverse it in the same month. You take the credit and reverse in the same month so that in the credit ledger, the entry is of zero amount, and down the line, if there is some favorable judgment which is coming, you will be in a position to reclaim the credit because there is no time limit for reclaim of credit. So for the civil part, claim and reverse the credit, and for the movable part and the plant and machinery part, better take the credit. No issues in that. Second is the cost optimization part of the SPV. See, at that time, what we were discussing is that, say, I'm a developer, I'm into an affordable project only. I develop affordable project. In case of affordable project, the rate of tax is 1% with no input tax credit. Now, as a developer, I avail interior designing services separately. I avail architect services separately. I avail construction services separately. I purchase cement separately. What will happen? Interior designer will charge 18% GST cost to me. Architect will charge 18% GST cost to me. Contractor will charge 12% GST cost to me. In some cases, I'm paying 12%. In some cases, I'm paying 18%. So 18% is always expensive because in any case, for 12% no credit, for 18% also no credit. So let me try to get this 18% to 12% only. Na? So what to do? Instead of giving a contract to an architect separately, better insert an SPV. You insert an SPV, you give the entire turnkey contract to the SPV. SPV will charge you 12%. And SPV will then avail 18% from architect, 18% from interior designer, and will get full input tax credit. And accordingly can utilize this ITC anywhere else also. So these are the planning areas which you can consider depending upon case to case, income tax implications and other implications, etc. But what we have seen is that most of the developers who are into affordable projects, they have formed a separate SPV as a contractor company to undertake the construction contract for them. What if completion certificate is not obtained from municipal authorities but obtained from a certified architect? See, what the law says is that you don't have to charge GST if you obtain a completion certificate from a competent authority or after first occupation, whichever is earlier. So you have applied for a completion certificate, but you have not obtained. So we have to see the local laws. Now in UP, there is a specific local law which says that if you don't get a reward within 3 months, it will be deemed to be a completion certificate, issuance of completion certificate. You can use that clause and say, I have obtained the completion certificate and hence not liable to charge GST. Now, Haryana, whenever you apply for an occupation certificate in the Haryana, it is specifically written that you have to obtain a architect certificate from a certified architect as per the local laws of the Haryana property laws. So that certificate itself is a completion certificate under the provision of Haryana. So you can use that. So answer to your question will depend upon state to state. Generally, if you have applied for occupation, you also have an architect certificate, and you have given the possession, and the delays on the part of the government, and you have done everything what you can do from your side, we can take a call that first occupation has occurred, and accordingly no GST will be leviable on fresh bookings. But it all depends upon case to case. There are certain issues related to joint ventures, etc. We will be discussing and taking up these issues of joint venture, joint development agreement in our next session, because we all need to understand together the implications of JVs. And most important is like the provision kept on changing. Service tax different provision, 1st July 2017 till 31st March 2019 different GST provision, after 1st 4 2019 different GST provision. So we will have various kinds of issues. Development agreement entered in 2017 but area allocation in 2020, what to do, which law to be applied. So all this will be discussed in our next session. What are the prerequisites for obtaining the occupation certificate? It depends upon the local laws. So whenever in a particular state you will have local urban planning and construction laws, you'd go there, and from there you will be able to see what are the prerequisites. I think we have covered almost all of the questions. Over to the organization. Thank you, and sorry for the inconvenience for the technical glitches.
Thank you, Mr. Aggarwal, for this insightful presentation. This has definitely added to our knowledge on the topic. I appreciate the subject matter and thank you for precisely explaining it to our audience. We shall look for the next part of the topic. I also thank the participants for being so cooperative. Thank you all for taking time out of your busy schedule and joining us in this session to make it a success. And yes, we shall send you a copy of the presentation in email for your future references. Though Mr. Tushar has tried to reply to the queries raised during this session, yet in case you have any further questions, you may please send them to us in writing at sales@taxman.com. Thank you all once again. We shall soon be back with another vital topic. Till then, stay safe and have a great time. Bye-bye.